Welcome, learners. Thrilled you brought us Markel Corporation's 2016 annual report for today's deep dive. You flagged this one, and you were right on the money. It's got this really unique mix of, right now urgency and this forever vision.
Yeah, what's really striking about Markel is how their financials, they really open a window, don't they, into a pretty distinct business philosophy, leadership style, and just this deep commitment to long-term thinking. It's more than numbers. It feels like a masterclass.
It really is, and that mini Berkshire Hathaway comparison, it's often made, and, well, for good reason. Their shareholder letters are consistently rich, full of strategy and insight, especially how they talk about building a great company facing, an always uncertain future that continues to change at faster and faster rates. Okay, let's unpack this then. Our mission today, to really pull out the core wisdom from this 2016 report, get a handle on their philosophy, how they actually measure success across these different parts of the business, and what it tells us about building something that lasts.
Exactly. We'll look closely at how they managed to weave that really long-term view into every single right now decision. It's something they explicitly call an immense competitive advantage. It's quite a balancing act.
And they kick things off right away in the report with that comedian Stephen Wright quote, "My goal is to live forever, and so far so good." It's kind of a funny way in, but it sets up their core idea, right?
Yeah.
Operating with these two time horizons, forever and right now, connected but distinct.
That's the absolute core tension, isn't it? I mean, in a world totally driven by quarterly results, what does thinking forever actually practically look like? Markel seems to believe this dual focus lets them adapt to, well, incredibly rapid tech change, intense market pressures. They call it a full sprint, winner-take-all race.
High stakes.
Very. But while doing that, they're also making decisions that build, long-term durability, not just chasing the quick win.
So it's a constant balancing act. If they're focused on right now, does that mean they're like super agile, quick to change, ditch old ways? How does that fit with forever?
Precisely the question. They argue the right now focus means making needed changes immediately. No clinging to the past just because. But, and this is the key bit, every single one of those right now moves is made in the context of forever, always aiming for that long-term health, the profitability of the whole company. Think of it like a chess grandmaster, always thinking end game, even on move one.
That's powerful. It really suggests a specific kind of company culture is needed to pull that off.
Oh, absolutely. And this is where those management letters are gold. They really reveal the culture, the strategy underneath. Markel flat out says very few companies have this profoundly clear mission and the freedom to actually execute it. And that freedom, it comes from decades of trust built with shareholders. They even explicitly thank them for it. It's a reciprocal thing. It underpins everything.
So this forever and right now idea, it's not just talk. It gets operationalized through what they call their three engines, distinct but connected: insurance, investments, and industrials. They just call that last one Markel Ventures, kind of their slang for it.
What, the three I's?
Let's pull back the curtain on how this philosophy works in that first engine. Insurance, which, as everyone knows, is a tough market. So 2016 numbers. They wrote $4.8 billion in premiums. That's up 4% from 15. And get this, an underwriting profit of $316.5 million. Combined ratio of 92%.
Yeah, that 92% combined ratio, that's really the standout figure there for anyone listening who maybe isn't deep in insurance. The combined ratio, it's basically the core profitability measure. Claims plus expenses versus the premiums they took in. Anything under 100% means they're making money just from insuring stuff before they even think about investment income.
Which is huge.
It is. And it's not just a number. It's strategic. It's the bedrock that lets them take calculated risks elsewhere, knowing the foundation's solid. And like you said, doing that consistently in what they call a brutally competitive market, that's pretty special.
And they've done it consistently. They say, 15 out of the 21 years in their history shown? Profitable underwriting. And they back it up with incentives, right? Bonuses only kick in if insurance makes an underwriting profit. That really focuses the mind.
Absolutely aligns everyone. Now, they break that combined ratio down, right? Loss ratio, what goes out in claims, and expense ratio, the cost of doing business. To get that loss ratio down, they're investing heavily. Big data, data analytics, predictive modeling, all that good stuff.
So that's a very right now tech investment, but it's aimed squarely at securing the forever profitability of that insurance engine. Any specific examples they gave of how that plays out?
Yeah, good point. They mentioned partnering with their wholesale division, created something called an express renewal process. Basically, automatic renewals based on portfolio decisions, not digging into every single
It
policy.
streamlines things.
Hugely. Better customer experience, simpler for them, and it lowers expenses all around. It fits perfectly with their mantra. A great company does things for its customers rather than to its customers.
Nice phrase. Okay, but on the other side, the expense ratio, they're pretty candid, aren't they? They say aggregate expense levels remain stubbornly high and need to do better. They point to things like compliance costs, IT, accounting, HR. Sounds familiar for a lot of businesses.
It certainly does. Their plan. Use fintech financial technology to get better at underwriting, marketing operations. But they don't see it as some, radical break. It's just adapting to new tools like the company did back in the 1930s. It's that right now adaptation, always within the forever context.
Okay, let's shift gears. Engine number 2, investments. So 2016, they report a 4.4% total return on their public stocks. But they make this really important distinction, don't they, between reported the one-year number and earned looking over 5 years.
Yeah, and this distinction gets right to the heart of, price versus value, that fundamental question. They explain that the reported 13.5% equity return for just 2016 might be, in their words, just a touch high compared to how the underlying businesses actually performed economically. But stretch it out over 5 years, and that reported 15.9% return for their stocks. That, they say, closely matches what they truly earned. Because that year-to-year market noise, the volatility, it kind of smooths out. It shows how longer time frames give a much clearer picture of real economic progress.
So they're basically saying, look, we care more about the real economics than the accounting entries. And they see that as a competitive advantage.
Exactly. And in their bond portfolio, that difference was even starker in 2016 because interest rates jumped up late in the year. They keep a pretty steady duration, 4 or 5 years, high credit quality, mainly to backstop their insurance promises. Over 5 years, though, those bonds mature, they get reinvested. So the earned interest and the reported interest pretty much line up. It naturally hedges their insurance side against rate swings.
Now, here's where it gets really interesting, I thought. They saw these accounting changes coming down the pike,
Yeah.
U.S. GAAP changes. Maybe just quickly for listeners, what's GAAP and what was this specific change about?
Sure. U.S. GAAP generally accepted accounting principles. Basically, the rule book for accounting for U.S. public companies. The change, starting in 2018, was that swings in the market value of stocks would flow directly through the income statement each quarter.
Making reported profits jump around a lot more.
Dramatically more volatile, yes. And Markel actually argued against some of these changes. Said they wouldn't be helpful, expected they'd have to spend more time explaining these somewhat confusing financial reports. They even dropped that George Bernard Shaw quote, "All professions are conspiracies against the laity."
Huh. A bit cynical maybe, but you can see their point. It really shows how companies have to navigate these rule changes, and it gives us another peek into their reporting philosophy.
It does, and despite these new accounting hurdles, they're crystal clear. They'll keep making the best economic decisions no matter how the accounting rules make the presentation look. Their core investment approach, those 4 points, it stays exactly the same. Profitable businesses, good returns, low debt, great management, reinvestment chances, fair price. Same stuff, different day, as they put it. That consistency is telling.
All right, engine number 3, industrials, Markel Ventures. And wow, 2016 was pretty spectacular for them, wasn't it? Revenues up 16% to $1.2 billion. EBITDA, that's a measure of operating profit, surged 81% to $165 million. Just massive growth from 10 years before.
It's huge. And it's not just growth for growth's sake. It really speaks to how well they executed the strategy of building these resilient, diversified cash flows, this collection of different businesses. It gives them income streams not totally tied to the ups and downs of insurance. It adds what they specifically call resiliency.
Right, they make that distinction.
They do. They argue resiliency is a much more important concept than diversification, because resilience means being able to really rise to new challenges and circumstances, whatever the market or technology throws at you. It's about adaptability, not just spreading bets.
That's a great way to put it. Resilience over just diversification. So the numbers look amazing, but then they say the results are actually both better and worse than what the raw numbers present. Okay, what's the catch there?
Good catch yourself. That $165 million EBITDA figure, it actually includes an $18.7 million goodwill write-off. That happened at one of their subsidiaries. Goodwill, remember, is that intangible asset recorded when you buy a company for more than its identifiable assets are worth.
So they had to admit something they bought wasn't worth quite as much anymore.
Exactly. This specific write-off reflected weaker performance tied to low energy prices, which had been stuck in a, quote, fundamental bear market.
So even in a spectacular year, they're taking this accounting hit publicly.
Right, and this really shines a light on their conservative accounting approach. They look at each business separately. They really focus on the balance sheet's integrity. They even call it a conservative and perhaps unusual degree of self-flagellation.
Self-flagellation. That's quite a term for an annual report.
It is. They point out this goodwill charge is a one-way street where only negative events get highlighted and charged off in lumps. If that business recovers and does great later, that good news won't magically reappear on the balance sheet to offset the earlier write-off.
So they're not just transparent, they're almost like aggressively honest with themselves in their accounting. That feels pretty rare when companies could easily try to spin things more positively.
It feels very rare. And they add another layer. If Markel Ventures was set up like a typical private equity fund, they'd likely be reporting positive mark-to-market gains,
Yep.
valuing assets at current market prices. But because they own these businesses directly, they avoid those often uncertain paper gains, and they avoid the high and certain fees that PE firms charge. So the underlying economic reality is actually better than the reported numbers suggest because they're not inflating things with potentially temporary market valuations.
Markel really does feel like a unique beast, as they say, driven by this culture, this Markel style. And they're very clear about how they prioritize using their capital right. First, grow organically. Second, buy new businesses. Third, put money into public stocks. And finally, buy back their own shares if the price is right.
Yep.
Same stuff, different day. Again, it shows incredible discipline, a clear hierarchy for how great companies should allocate capital. And they argue their long-term financial success isn't just luck. It reflects this underlying reality of personal relationships and business excellence.
Yeah.
It's not just spreadsheets. It's the people and the principles behind them.
And speaking of people, this is where I thought it got really interesting. In their discussion of culture, they bring in quotes from, of all people, Bruce Springsteen. The guy standing next to you is more important than you think he is, and the legendary coach, Vince Lombardi, individual commitment to a group effort.
Yeah.
They apply these ideas directly to Markel, calling themselves the band. It's profoundly powerful, that insight into leadership and culture. They literally describe their secret weapon against all the modern challenges: technology, speed, hyper-competition. They say it's the humane trust and interconnectedness within the company that allows them to operate as a group, achieving far more together than they ever could as individuals. It's this incredible statement about human capital, about collaboration in an age obsessed with tech.
It almost sounds, I don't know, old-fashioned,
Yeah.
focusing so much on people. Yet they position it as their cutting-edge advantage for the future.
Exactly that. It's taking that forever value, human connection, trust, and applying it directly to the very right now challenges of constant rapid change. It's quite something.
So wrapping this up, what does this all mean for you, the learner? I think Markel's 2016 report, it's way more than just a financial doc. It really feels like a blueprint for building something resilient, something that lasts. From that forever and right now thinking to the focus on their 3 I's, and especially that emphasis on collective trust. It's clear they believe in thinking deeply, acting decisively, but always, always playing the long game.
I agree. Their whole approach to reported versus earned returns, that conservative accounting in Markel Ventures, even just how candidly they talk about the challenges in insurance, it all pushes you to look beyond the surface numbers, to understand the deeper economic reality. It really encourages critical thinking about how companies truly measure success and build lasting value, getting past the easy metrics.
And maybe the most surprising takeaway for me was just how much they value the guy standing next to you, framing that personal commitment, that trust, as their ultimate competitive edge in a world that's changing faster than ever. It's quite a reminder that even with all the tech, human connection, and collaboration, well, they still seem to be paramount.
It really leaves you thinking, doesn't it? In your own work, your own life maybe, how consciously are you balancing those urgent demands of right now with a longer strategic vision of forever? And how much true resilience are you building, not just diversification, to handle whatever changes come next?
That is definitely a powerful thought to chew on. Well, thank you for joining us on this deep dive into Markel's unique world. Until next time, keep digging, keep learning.